So how do you actually help us to interface with the clients?
Myself and other members of the staff will write what's called a market reflection. That comes out twice a month about hot buttons on what we're hearing and seeing in the investment markets. And then we have performance reporting. So our touches with the client, our dialogue, it's an ongoing process and it doesn't stop.
Tell me about risk tolerance. That's a concept that might not be familiar to everybody. Walk through that, and how do you go about finding your risk tolerance?
In this segment, we'll be discussing the importance of not outliving your income in retirement.
A Roth IRA conversion is a powerful tool, and this segment will illustrate the tax advantages it offers.
Hello everyone, and welcome to this week's episode of Financially Fit. I'm Corey Sickles. I'm the president and founder of Safe Harbor Wealth Advisors, and I am an investment advisor representative. Safe Harbor Wealth Advisors is a fee-based, registered investment advisor providing financial planning and third-party asset management.
Hi, I am Gary Sickles. I'm the president and founder of Safe Harbor Wealth Management, and I am an investment advisor representative. Safe Harbor Wealth Management is a fee-based registered investment advisor, providing financial planning and third-party asset management.
Now, I've partnered with my father, Gary Sickles, to offer a team approach through Safe Harbor Retirement Group, our family-owned, independent financial planning firm offering a comprehensive range of services for retirees and those planning for retirement.
We have the experience to provide our clients with the information needed to help make sound decisions for their future retirement security. The next 30 minutes will be filled with retirement information, presented in a simple manner that you can understand. So stay tuned, because Financially Fit with Safe Harbor Retirement Group starts right now.
Welcome back to Financially Fit with Safe Harbor Retirement Group. This segment, we're going to focus on our wealth management with Safe Harbor Wealth Advisors. We've been a partner with Gradient Investments since 2009, and one of the things that we really want to get into today, Mike, is I'm going to be able to ask you questions for once. Mm-hmm. You know, I'm always the one asking you on what we should really do for our clients.
That's right.
That want to invest in the market. But what I'd really like to do is kind of, turn the table here. Once a client really becomes a client and we allocate them the correct way, one of the things that we also want to be able to do is have annual reviews and meet with them regularly to keep them updated on market performance and what maybe even do with the portfolios. So how do you actually help us to interface with the clients?
Yeah, that's a great question. Well, the answer is we do a lot of things. Part of that, we believe that there's the initial meeting and the initial allocation, and a lot of folks frankly stop there, but we believe in an ongoing relationship with clients because things change, things in clients' lives change, things in the market change. There's a lot of change going on out there. So if we put out roughly 3 monthly pieces that we write. One's a month-end report by our chief investment officer, and he does that every month. That's sent out to your clients. Myself and other members of the staff will write what's called a market reflection. That comes out twice a month about hot buttons on what we're hearing and seeing in the investment markets. And then we have performance reporting. So our touches with the client, our dialogue, it's an ongoing process and it doesn't stop. And as we know, market conditions change. And when they change, we need to convey that to you. Our forecast may change, and then we can reallocate clients. And it's just an ongoing process, and we believe that's the right thing to do.
Again, back to the allocation piece. So when we start working with clients, one of the things we really try to do is be able to have some opportunity for growth. Mm-hmm. And tell us a little bit about some of the growth portfolios that our clients can invest into for the long term.
Yeah, so like I said, we have a wide variety of portfolios that we offer to clients, and frankly, clients need a wide variety of portfolios. And they range from everything that's more conservative, which means fixed income or bond market portfolios, all the way up to high growth and stock or equity market portfolios. So when we're talking about our growth portfolios, we're more in the stock market arena for those portfolios. We have 2, I'm going to say, flagship type of portfolios that are great portfolios right now. One's called the Gradient 50, and the other one's called the Gradient 40i as an international. So let's talk about the Gradient 50 first. That's a US-based blue chip dividend-paying, dividend-growing portfolio. has 50 individual stocks in it. We screen and analyze these companies. We want to make sure they're blue chip. And we also have yield hurdles where we want to have a dividend yield that's strong enough for them. So at the end of the day, this is not only a blue chip portfolio. Your clients are going to, they know most of the names that are in this portfolio. They've heard about them for decades, and they'll continue to know them, in our opinion. And they have a long, long history of not only paying that dividend, but growing that dividend. So it's really, when I say a dividend paying and a dividend growing, these companies have a history of raising that dividend, and that's an inflation hedge because they tend to raise those dividends on an annual basis that's higher than the rate of inflation. And the G40I is simply its counterpart, except these are blue chip, dividend paying, dividend growing companies that are based internationally. Okay, so investing in those two, you get a great stable of blue chip stocks that pay dividends and grow those dividends around the globe.
And my last question that I want to ask you is, what do you see some of the common pitfalls that you've seen? I don't want to say from my clients, but just from clients in general.
Yeah, and that's a great question because investing is a tricky business. I mean, if it was easy, everyone would do it and everyone would be rich, right? So the biggest pitfall that we see out there, the easiest thing to say is, I'm going to buy low and I'm going to sell high. It's the easiest thing to say, but it's actually the hardest thing to execute. And what we find is that most clients actually do it the reverse. They tend to get despondent at bottoms and sell, and euphoric at the tops and buy. And that destroys value faster than anything. So I think part of working with professional advisors who work in our partnership here, part of what we do over time is we help manage client emotions. We help separate the noise from actually the fundamentals of what's going on in the companies that we invest in. And I think over time, we tend to help clients reverse that process and be opportunistic. So when things are low and maybe we have a correction or not a crash, we have the flexibility to now add or buy stocks low. And then when things get a little rich, we have this thing called monthly portfolio tilts. And not all our portfolios are good through thick and thin. And we'll recommend some portfolios and we'll say maybe it's time to sell some of this portfolio and buy some of this one. But we'll help manage that emotional cycle of up and downs in the markets. So I think helping manage client emotions in the ups and downs of the market and all the noise that they're hearing out there and prevent them from selling low and buying high and reversing that cycle where we're actually buying underperformance and selling outperformance. I think that really adds value over time, and that's what we're here to do to help them over time too and add value.
Well, Mike, thanks for joining me today.
My pleasure.
Again, Mike Binger, President of Gradient Investments. Do you have any questions about anything we discussed today? Feel free to give us a call at 888-208-4103, or you can also visit our website at safeharboroh.com. Thanks for joining this segment of Financially Fit TV, and we'll be right back.
Hey Dayton, don't forget to join us for Financially Fit Radio to learn about important retirement topics. Listen every weekend on 95.7 FM and 1290 AM. One more time, join us for 95.7 FM and 1290 AM every weekend.
A prosperous life requires that you find your financial path. Don't do it alone. It's much too important for that. As you move along your chosen financial path, it can be reassuring to know that you don't need to do it on your own. Sometimes the unexpected can happen and knock you off your path. Or you may reach a crossroads and need to make an important decision that will affect your financial life from that point on. If you have financial goals set, it's not always easy to tell if you are right on track or falling behind. And sometimes you just need someone to help explain the rules. As you continue your financial journey, find the right professional to be your guide. The financial help you need when you need it. One more way the Financial Pathfinder isn't just a game, it's real life.
Welcome to the Financially Fit Show. Today I'm here with Corey and Gary Sickles. We're going to go through a few common questions that we get from our viewers, and I'd like to talk a little bit about just generally retirement planning. So tell me about risk tolerance. That's a concept that might not be familiar to everybody. Walk through that, and how do you go about finding your risk tolerance?
Yeah, when you look at risk tolerance, really all it means is am I a conservative investor? Am I kind of a balanced investor, or am I more growth oriented? And one of the things that you'll find out is as you go through, through your working years, you're going to become a little bit less conservative as you kind of go through this process. So one of the things that we do for our clients every year, the first time you come in, we're definitely going to do this, but even at annual meetings, we're going to sit down with you, have you take a little survey, which is 11 questions, and you can also go to our website at safeharboroh.com to take that risk score. But we're going to look at that risk score because it's going to tell us on how we really should allocate your assets. And what I will find, what we do see year in, year out, especially with the market being in a bull market for the last 9 years, is people's assets have grown. They've kind of forgot about it. This year they haven't forgot about it, but they kind of forget about it. And what gradually has happened is you've gotten a little bit more risky than where you really should be. And that's why you should look at your risk tolerance every year and then allocate based upon that as well.
And Gary, you talk a lot about something called the Rule of 100, which goes back to the age side of things. Will you talk through, if somebody hears Rule of 100, what does that mean to them?
Well, it's basically going to help us measure their risk. And one of the things I've found over the years is as people age, they become more and more conservative because of their time horizon. So again, the Rule of 100 means you always start with that magic number of 100. Then you subtract your age. So again, if I work with somebody 40 years of age, then they're going to be a lot more riskier than if I'm working with somebody 60. If I'm working with somebody 60 years of age, 60% of their assets should be in some type of safe type of environment. We can be a little bit more aggressive on the other 40%, but here again, as we age, people's going to become more conservative because of their time horizon.
We've had a great run here with the market, and in general, people are confident in where they're sitting. However, that also makes them say, why? Why would I need to work with a financial professional when I've been successful? Corey, walk them through the role or the role of a financial professional and how that can make an impact, especially as they start to retire.
Yes. I mean, we of course, we're going to be able to help you build that income plan to make sure you're going to have, some type of income that's going to last your lifetime. We kind of already talked a lot about that. But here's what I would say to that one question is allocation's key. Now, one of the things, if you're just doing your own investments today, one of the things that you really need to look at is, are you allocated the correct way? And that's where we really can help you out. Because the one thing that you don't want to have happen is you don't want your entire portfolio to experience another 2008 where it could possibly drop 40% within a short amount of time. There's nothing wrong with having if you're allocated the correct way, that portion of the money that should be in the market, experiencing that, but you don't want your entire portfolio. And one of the things we're also going to be able to do is not only from an allocation and an income standpoint, but when times do get a little bit, volatile like they are now, we're going to be able to say, we have a plan. We have these assets allocated for you that's going to be in the market. Keep it where it is because your entire portfolios are going to experience those ups and downs. And you can do your reading on books out there or different type of financial articles about this. But, most people actually, buy high and sell low. We're really here to kind of guide them through that, through that experience that, because they're going to want to get out of the market when it drops 10%. We're here to say, we have a plan. You're allocated the correct way. There's nothing wrong with a little bit of a correction on this portion of your portfolio.
This has been another great segment of the Financially Fit Show. So Corey, if they want to get in touch with your organization, what's the best way for them to do that?
The easiest way to do it is visit our website at safeharboroh.com, or you can give us a call at 888-208-4103. And if you do visit our website, there's also a place where you can sign up for a complimentary meeting with us. And I would highly recommend that.
Again, another great segment of the Financially Fit Show. Thanks for joining us, and we'll be right back after these messages.
Investing in the market can be confusing. With all of the options and constant movement, it can be difficult to know where to allocate your money. Are your assets managed in a way that helps maximize your returns? Let us help answer this question in conjunction with our strategic partners using the Portfolio Analysis Review known as PAR. The PAR process includes a detailed analysis of your current asset inventory, Morningstar reports, and personalized portfolio strategies to help you understand the risks and rewards of your current financial situation. Begin charting a course that can potentially help maximize your assets with the comprehensive Portfolio Analysis Review.
Welcome back to Financially Fit with Safe Harbor Retirement Group. I'm Corey Sickles. In this segment, we'll be discussing the importance of not outliving your income in retirement. Prior to retirement, your financial life was dictated by a simple financial paradigm. You earn money and you save money. But once you retire, that familiar way of living changes because you no longer will be earning a paycheck. As the need for income carries on, even after your working income ceases, it's important to develop a retirement strategy that can help you ensure the amount of money you have is aligned as closely as possible with the amount of money you need.
Developing a sustainable, reliable, and feasible plan for one's retirement may come down to one basic question. Should you ask yourself, how can I make my money last as long as I will?
That's such an important question. It's no secret that arriving at your ideal retirement destination does require some navigating. When should you file for Social Security? How can you minimize your taxes? Which financial products can be leveraged to help generate income? Answering these questions also means you may want to think about your financial accounts in a new way. In other words, overcoming all the financial obstacles you may encounter along the way means you will want to think about more than just the route you will take. You may also need to think about the vehicles you will use.
It's important to organize your money in ways that can help provide both immediate and future retirement income. In order to accomplish this, your assets will need to be secure enough to generate a steady stream of income on day one of your retirement, but still be involved with the market enough to maintain some growth potential to generate the income you may need for later. I believe that having a profitable and sustainable retirement comes down to how effectively you're able to balance your hope-so money with your no-so money. No-so money consists of low-risk assets, allowing you to be reasonably depend on them to be there when you really need them. Hope-so money is more exposed to risks, but also gives greater return on the potential. Balancing your no-so and hope-so money is important of making sure that your retirement income will potentially last as long as you do.
Although there is no hard and fast rule used to determine how much income you'll need in retirement, our general rule of thumb is that a retiree is going to require somewhere between 70 to 80% of their pre-retirement income to maintain their current lifestyle. Whatever your income need may be, once you have identified it, it can become much easier to see how to best balance your portfolio. Will the combined income from all your no-so money assets be enough to satisfy your income need? For many Americans, the answer to this question is no. Frequently, a retiree's income needs to surpass what their current assets are able to provide. This shortfall is referred to as the income gap, and how you choose to fill it can help chart the course of your retirement.
Once someone figures out their financial shortfall or their income gap, savings may help them meet their financial goals, but simply having a savings is rarely enough. Even the most frugal and diligent of savers may struggle to create a nest egg large enough to support their retirement. You should craft a retirement strategy that balances your need for asset preservation and retirement income, but you still have to have some growth potential. In other words, how you balance your hope-so and your no-so money can help determine how effectively you are able to budget your income gap. Creating the retirement income you'll need may have less to do with how much money you have, even more to do with when will you really need it. Essentially, filling your income gap will be the result of strategic, innovative, purposeful retirement planning.
A case study by Prudential titled "Should Americans Be Insuring Their Retirement Income?" tackles common risks faced by retirees. The report points out the following facts. Individuals routinely insure valuable assets. However, far fewer insure their ability to generate lifetime income. During working years, an individual's most valuable asset is often the ability to work and generate income. The two main risks to be able to generate income are premature death and disability. Individuals can insure themselves against the impact of these risks when approaching and then entering retirement. An individual's most valuable asset may be the savings from which he or she must generate retirement income. Three significant risks to being able to generate that income are longevity, risk, market uncertainty, and an extended period of low interest rates. The report goes on to say that the impact of these risks can be harsh, and retirees can find themselves with a substantial income shortfall should their assets be exhausted. However, there is good news. With careful planning, individuals can help protect themselves against the impact of these kinds of risks.
Creating the retirement income someone needs may have less to do with how much money they have and more to do with where they have it. Essentially, filling one's income gap is usually the result of strategic and meaningful retirement planning. The key is to match your income need with the correct investment strategies, options, and tools to satisfy that need. The solution will be different for everyone, and the way to find the one that's right for us is by working with a retirement professional like us.
Now you can visit our website at safeharboroh.com or give us a call at 888-208-4103 and come in for a complimentary meeting with us. Now let us show you how to structure a retirement plan designed to help make sure you don't outlive your retirement savings. Hey Columbus, don't forget to join us on the radio for the Financially Fit radio show to learn about important financial topics. Listen every week on 98.9 FM, 920 AM, and 96.3 FM radio every Sunday morning. One more time, join us at 98.9 FM, 920 AM, and 96.3 radio every Sunday morning.
Welcome back to Financially Fit with Safe Harbor Retirement Group. I'm Gary Sickles. A Roth IRA conversion is a powerful tool, and this segment will illustrate the tax advantages it offers. First, Roth accounts are simply a retirement account that can be the form of an individual retirement account or an employee-sponsored retirement account that allow for tax advantage growth of earnings and tax advantage income. The main difference between a Roth and a traditional IRA or employer-sponsored plan lies within the timing of the taxation. You may be familiar with the typical scenario of putting money away for retirement through the employer plan, whereby they deduct money from our paychecks and put it directly into a retirement account. This money is taken out before taxes are calculated, so we do not pay on those earnings today. A Roth account, on the other hand, takes the money after the taxes have been taken out and then puts into the retirement account. So you do not pay the tax on the money today. The other significant difference between these two is taxation during the distribution in later years. With our traditional retirement accounts, when we take the money out, later it gets added to our ordinary income and gets taxed accordingly. Additionally, by including this in our income, it subjects us to such things as Social Security taxation, higher Medicare premiums, and other taxes. A Roth, on the other hand, gets distributed without taxation and does not contribute towards negative impact items such as Social Security taxation, Medicare premium increases, and other taxes. It essentially comes back to us without tax and other obligations. The best way to view the difference between the two accounts is to look at the life of a farmer. A farmer will buy seed, plant in the ground, grow the crops, and harvest it later for sale. Typically, the farmer would only pay tax on the crops that have been harvested and sold. Let me ask the question. However, if you were the farmer, would you rather pay tax on the $5,000 worth of seed that you plant today or $50,000 worth of harvest crop later? The obvious answer is $5,000 worth of seed today. The truth to the matter is that you are a farmer. Only you plant dollars into your retirement account instead of seeds into the earth. So you have to decide if you want to put the money in a vehicle that gives you tax advantage income options down the road. But to do so, you pay to convert a traditional IRA to a Roth, which has its own pros and cons. While you have to pay a conversion tax to transfer your assets, you also have turned taxable income into tax advantage retirement money that you can let grow as long as you want without being required to withdraw it. If you pay a 25% tax on that conversion and the Roth IRA then doubles in value over the next 10 years, you could look at your situation as only having to pay 12.5% tax. The purpose of tax advantage income is a tempting one. Make sure that you're working with a financial services professional like myself to understand potential tax opportunities. Don't forget, everyone's tax situation is going to be a little different. Visit safeharboroh.com or call 888-208-4103 and schedule a complimentary meeting with me. We'll be right back with more from Financially Fit with Safe Harbor Retirement Group. Thank you for tuning in to Financially Fit with Safe Harbor Retirement Group.
On today's show, we hope you found retirement information presented in a simple manner that you can understand. With the help of the right financial services professional, you can create a quality retirement. And we are here to help. So you can go to our website at safeharboroh.com to continue your retirement education or give us a quick call at 888-208-4103.
If you have any questions or comments about today's show, contact us at 888-208-4103.
Now join us next week at the same time and same place for another episode of Financially Fit with Safe Harbor Retirement Group.